After having self-custodied my coins for many years, I deposited them into FTX. And shortly after that, FTX went down and my entire crypto stack just gone.
Talk to me about Paradigm and why Paradex was born out of Paradigm.
With options, a lot of people are trading in a more complex manner. And that business was solving pretty specific use case, which was...
There's another component, which is privacy. Can you talk to me about that?
One of the things that's very apparent in exchanges that are fully on-chain is that there is no concept of privacy. Finance does not scale without privacy because...
Perfect. Excellent. We continue here at token 2049 today, or I guess we're post conference now, but still in Singapore. Just before we started recording, you mentioned to me a story about FTX, and I would love for you to cover that because I think it's really relevant to what you're building and why.
Yeah, so maybe it kind of starts back to how I got into crypto in the beginning. So I spent my early career in investment banking at Goldman, mainly covering like fintech, market structure, asset management. And I was at some dinner with my friends probably back in like 2013, and one of my friends who actually now runs a pretty successful media company was basically like our first guy to buy Bitcoin, right? I think he bought it at $40, sold it at $100, but he started talking about this thing, Bitcoin.
Right.
And I remember coming back from this dinner and still not really understanding what it was, anything really about it. But it got me kind of like starting to follow, what is this crazy new technology? And then I kind of was following it through the Mt. Gox hack and kind of just watched the price come down. And in 2015 decided to basically, I'll put some money in if it hits a certain price, and then I'll kind of learn about it afterwards. Right. So I kind of just took the dive, bought some Bitcoin, and then basically spent the next year, trying to read up and figure out, what the hell I just bought. And so basically it brought me to a book, Mastering Bitcoin by Andrea Antonopoulos, which was like the foundational piece for me, like getting red pilled into the Bitcoin space. And so in 15 kind of started Bitcoin, 16, I convinced my bosses at Goldman to basically say, hey, can you just let me go to Consensus New York in 2016?
Right.
And I actually ran into like a tertiary friend of mine from Vanderbilt, where I went to college, who was starting to build one of the first DEXs on chain on Ethereum.
Oh, cool.
Like way back in 2016. And he was like, oh man, there's this thing called Ethereum. Like you have to check it out. You have to buy it. This is going to be like the next big thing in crypto.
Right.
So then I started learning about Ethereum, and then I had this aha moment with smart contracts on chain that like, oh man, this enables you to build companies basically in code on chain with, a fraction of the headcount.
Right.
So I was basically trying to convince my bosses at the time in the TradFi world to like let me cover crypto companies. I want to try and do something in the space, and pretty much got laughed out of the room. Right. And so that basically led me to my journey to say, okay, I have to leave banking. I have to get into the space. So I hopped into my first startup called Noble Markets, which was basically doing banking and settlement for the early crypto exchanges and stable coins. Unfortunately, that business didn't make it through the cycle of 2018. But I kind of knew I wanted to stay, heavily involved in the space, and ended up meeting the founder of Paradigm, which has incubated Paradex, so we can get into that later. But basically met him when he was just a guy in a room with a couch and one other co-founder. But realized that like, this was a founder I wanted to be associated with, and his vision for Paradigm. And at that time we started to talk about building a DEX as well. For Paradex was something that like I had to be a part of. And so in 22, late 21, basically, agreed to come on at Paradigm, and basically sold all my possessions, moved to Asia with 2 duffel bags, and got started. And one of the critical things I did during the 2022, after basically having self-custodied my coins for many, many years, was I deposited them into FTX. And shortly after that, FTX went down, and like all of a sudden my entire crypto stack from 15, 16 just nuked, zero, gone.
Right.
And I think, as we think about like why we built Paradex, this was a huge reason. Like fundamentally having that like crazy situation of being, having all of your coins basically stolen from you, and there's nothing you can do about it. was a big reason why we're like, okay, centralized exchanges, like the whole point of crypto was basically to avoid these risks.
Right.
And so like, what are we doing building these centralized businesses? We need to build on chain. And that was a huge inspiration for myself and on the other, the founder of the business, for us basically saying, okay, now's the time we have to build an exchange.
Mm-hmm. Yeah. And it's almost like in a lot of ways, something like FTX validated the need for, validated the product market fit for something that maybe couldn't quite be built on chain or wasn't ready to be built on chain, but it really left open this like massive market opportunity that had been totally proved out. Okay, a user-friendly product, with perps, with coin margin, like with all the good features about FTX, but the on-chain self-custody crypto native components is like the market winner essentially, right?
Yeah.
It proved it out.
Yeah, and it's funny because my first company, Noble, basically our value prop at Noble was mitigating counterparty risk.
Mm-hmm.
And at the time, no one really cared. And it was this funny thing where a lot of us came from traditional finance, and counterparty risk is a huge thing people think about. But in crypto at the time, basically no one cared about it. And ultimately, counterparty risk became like the number one priority when FTX went down, because basically that was, that was the risk that blew everyone up.
Right. And do you think we think about counterparty risk less in TradFi because companies are already so established, or is it because of regulation or something, or like what is the reason there?
Well, I mean, I think a lot of lessons in TradFi, basically, like the way custody works in TradFi is very different, right? You have qualified custodians, you have central clearinghouses. So like the concept of self-custody is just very different.
Right.
And there's just a completely different set of risks in that world. But that's also been born out of like, over 100 years of learning experience and regulation to basically protect customers. Whereas, in this DeFi world, we basically are starting from scratch and trying to build it with code. Like learning the same lessons that many learned in TradFi, over the last century.
Yeah, I was going to use those same words, like learning the same lessons. And I also feel like people who come from traditional finance have a really unique perspective on crypto, where they're like, why do we need to go through some of these things that we need to go through, or that we're going through? Because often like, crypto natives or someone crypto curious will step into the space and doesn't understand, some DeFi primitive kind of really already exists in the TradFi world or something, or, there's some, standard that already exists of operation and has to be kind of relearned or rebuilt in the crypto space. And I guess we're just kind of getting up to speed there.
Yeah.
Awesome. Well, let's talk a little bit about Paradex. I guess Paradigm might be the interesting place to start there. So talk to me about Paradigm, and then why Paradex was born out of Paradigm and what you guys are doing.
Yeah, sure. Yeah, it's pretty critical of the story. So basically, when I joined the company, I joined Paradigm. And Paradigm, I think the simplest way to think about it is an institutional exchange for crypto options traders.
Okay.
There's some more nuance there, but I think that's the best way to think about it. And basically, that business was solving a pretty specific use case, which was, options trading is very different than perpetual futures trading. It's a lower liquidity asset class in general, and with options, a lot of people are trading in a more complex manner, right? You're not simply going long or short, a spot or future instrument. Many traders are trading structures, right? So it's whether it's calendar, flies. There's a lot more complex design space for what institutional traders want to trade, and they're also creating complex instruments on the back of that to generate yield using options. And so Paradigm was basically born out of, how do we create an exchange where large institutional players can basically focus on two things, which is they need to execute very large size trades. They often need it with very quick immediacy because they're in an axe to get in and out of a position. And then there's also the complexity of execution, which is they're not just trading, straight up puts, calls, they're trading these structures.
Right.
And so Paradigm basically created what's called RFQ for crypto options. And RFQ is basically a different way in which buyers and sellers match. So most people are probably most familiar with the central limit order book. But RFQ is a different protocol, a little bit darker execution, where basically, if I am a price taker and I'm looking for liquidity on a certain structure, I come to Paradigm, I build a trade. It could be any of these structures. Let's say I want liquidity on a fly. I then come to Paradigm, I build the trade. I then send an RFQ to a set of dealers that Paradigm has basically curated. They will show me a two-way price on that instrument. If I decide to trade against any price, I trade on Paradigm, and we basically match the buyer and the seller.
Mm-hmm.
And then the difference is we actually use exchanges, so Deribit in the case of the options world, as a settlement layer. So we match a buyer and a seller. We send a message to Deribit and says, hey, buyer and seller are matched at this price. Will you accept this trade? They basically check the margin on their system to see if the two users have enough margin. If they do, they accept the trade. And then the position actually exists in your Deribit account.
Mm-hmm.
So we are mainly, Paradigm is liquidity and execution. And then we use centralized exchanges basically as our clearing houses.
Okay.
And that really was very, very successful with OTC desks. And so we basically built that business, and it now does about 35% of Deribit's volume come through the Paradigm business.
Wow.
And that's all these large OTC desks, sophisticated market makers, but it's really an institutional audience. So a lot of retail folks aren't as familiar with that business because it's mainly used for, very, very large trades or complex options trades. But kind of born out of that experience was that we had this dependency on exchanges for clearing. And that prevented, the speed at which we could move, right? Because we're a small company, we're moving fast, we're innovating. But if we're having to move at basically the speed of the exchange, it makes it difficult for us to innovate.
Right.
And so basically out of that, we were like, hey, we're really dominant in options. So we probably have like a 90% market share of the institutional block options space. But we have bigger ambitions, right?
Mm-hmm.
And we don't really have a way to play in the futures business or in the spot business. And so like, how do we do that? And we've never wanted to build a centralized exchange for the reasons of both of us having gotten wrecked on FTX and being very concerned about how do we protect against, any sort of, even the potential of bad behavior from the exchange. So basically we decided, hey, if we want to do this, we need to kind of go build it ourselves. And so I think in 23, late 22, 23, we started going about to build an exchange. And so basically we incubated Paradex out of the Paradigm business. And we launched in October 23 on mainnet. We basically spent about a year in beta. So most of 24, we were in kind of an open beta. And then really we took the training wheels off in late 24, 25, at which point we were really, live in the market.
Right. So talk to me about the specific kind of design decisions, architecture decisions about Paradex and how you guys differentiate from the rest of the market.
Yeah. So it's an interesting time because I think if you look at just the broader landscape and design choices now, when we were first basically selecting tech, this is back in 22, the availability of layer 2 solutions was very different than it is today.
Right.
And so at the time we were really looking at, okay, do we build on Solana? And we had some people on the team that wanted to build on Solana. And there were other people that were like, well, we really like this idea of an application specific roll up.
Mm-hmm.
Because for us, we kind of, having built an exchange, we kind of knew the complexity and the demands of what it would take to scale something.
Right.
And for us, having this like shared execution layer versus having our own app chain where we can customize it purposely for a very specific use case in terms of an exchange, that was very important to us. And so we were starting to explore more in terms of like, if we go the roll up route, how do we do this? Do we go optimistic roll up? Do we go ZK based? And basically for us as an exchange, the idea of an optimistic roll up having basically a 7-day period where you can roll back any transaction was for us like, this does not work. Mm-hmm. Like our customers, if they think they have a fill and a settled trade, we can't have this risk of like, oh my God, 7 days later we bust the trade.
Right. It has to be a better product than a centralized exchange, and a centralized exchange would never operate in that way.
Exactly. So we basically then decided, okay, ZK is the way to go. And we love this concept of like on-chain, basically on the Ethereum layer, you just commit state diffs. And then you have this mathematical certainty that comes from the ZK proof that basically ensures all the computational integrity. But then you have very light commits actually on the, the sovereign layer of Ethereum.
Right.
So yeah, that basically led us to work with the Starknet team. And we basically really kind of helped innovate on, we want to do an application specific version of Starknet. And so we went to them and we pitched them the idea of saying, hey, let us take public Starknet, let us run it as an app chain. And that was basically how we born the Paradex chain, which is now basically a Starknet based application specific chain directly for Paradex.
And then I know there's another component, which is kind of privacy. Can you talk to me about that?
Yeah. So I think, one of the most important things, and this goes back to like the TradFi lessons learned,
right,
is when you compare the stacks of a bunch of different exchanges, one of the things that's very apparent in the exchanges that are fully on chain is that there is no concept of privacy. And that happens at two layers. That happens at the trade execution side, so pre and during the trade, because basically you're trying to compete for block space for the trade, and that opens up MEV and other attack vectors. And the second is once you've entered a position, who can see your position?
Right.
And for us, both of those things, very important that privacy is there, because as we look to scale crypto from where it is today into the future state, if we expect large institutions to come on chain, privacy is a fundamental right in finance. Now there's after the fact transparency. So like if you look at exchanges in TradFi world, the execution at the time is private, but there's 15-minute delay, there's feeds of every trade that happens. So there is transparency, but it's not shown at the time of execution.
Right.
And then if you look at like filings in the US, so like hedge funds have to file quarterly basis what securities they own. But that really does two things, right? One, as a large institution or large trader, you don't want to signal to the market what you're doing, right? That's going to leak, that's information leakage. That's how you generate your alpha. So you want to prevent other people from being able to basically take your strategies and use them. And then two is once you've entered a position, you don't want, especially in perps trading, you certainly don't want people to understand where you could get liquidated.
Right.
And basically you're creating like a giant target for yourself. Or if you're a fund, then like, how am I supposed to sell my alpha when basically you can look on chain and see every single position I have? It makes it harder for me to sell, my value prop.
Yeah, we don't even think about that. Almost like wallet tracking is kind of like a native part of the space, and we don't even think about how that doesn't exist, or there's nothing similar that exists in TradFi.
Yeah, and I think that's again that goes down to like crypto was born out of retail, and retail doesn't care as much about these things. But like as we scale and mature as an industry, we fundamentally think that like finance does not scale without privacy, because large capital allocators, that is like just table stakes for them to come in.
I've talked to a lot of founders this week and last, and a lot of them are becoming more focused on privacy for that exact reason, for institutional adoption. And really, I think what happened is the tech wasn't ready for privacy solutions, and now it is. And thus, now we're building privacy solutions to gain institutional adoption. So it kind of took phases. The last question I have around the architecture of Paradex is around RFQ. So does the same concept exist on Paradex?
Yeah, so it's a great question. So I think fundamentally when we think about like, what Paradex is trying to build, we talked a little bit about central limit order books, and that's mostly when you see all the exchanges, most of them have central limit order books.
Right.
But Paradigm being born out of RFQ, it kind of gave us a unique perspective on like, first of all, what is liquidity, right? And not every, like central limit order books are great for some type of execution. RFQs is great for other execution, as born by like our dominant share in the options world.
Right.
And so our fundamental view is, as we build Paradex, we're not just building a central limit order book exchange. We're really building, liquidity in any way that you want to access it. And so that means long term, we are going to plug Paradigm into Paradex. So you'll have RFQ available.
Okay.
And this will be most relevant when we have options and things like that, but it'll also be relevant for futures and spot. We'll have the central limit order book. We're going to enable, dark executions, so dark pool trading. But basically, liquidity is always a trade-off of basically you're looking at price, you're looking at size, you're looking at how immediately you want to execute, what the risk of information slippage is, and the complexity of trades. So like liquidity is really like a 5-dimensional surface. And each protocol, whether it's central limit order book, RFQ, basically can optimize for maybe 3 of those 5 things. And so for us, we want to basically give everybody a choice as to what protocol do you want to do to get the best execution you want. And we want to basically be offering everything to everyone. We don't have necessarily a view that this is the only, central limit order books are the only way to match buyers and sellers. We want choice for our users. And that's kind of comes uniquely from our experience having built an RFQ platform.
That's a really interesting. I never thought about liquidity as like kind of this like multi-dimensional almost product, really, where it's like there's preferences within how I want to make a trade, and really only kind of the current dexes or even centralized exchanges offer a retail user kind of like one dimension of liquidity. That's an interesting perspective. Okay, I want to get in the perp dex space a little bit because obviously perp dexes has been this kind of massive narrative. We saw perp dexes kind of bubbling up maybe a couple of years ago, but there wasn't any real adoption. And now in the last year, 2 years, we've really seen meaningful adoption of on-chain products, on-chain perp dexes, and the space has exploded, especially in the last month, exploded massively. What does it take to build a winning perp dex?
Yeah, it's definitely been interesting, and as someone building the space, seeing the explosion of perp dexes and competitors come into the market, I think it is very hard, right? Like if you ask the team, so we have about 30 people globally now on the team, and we have been grinding for over 2.5 years building this thing. Right. And it is not easy. It's not, it takes every little bit of you to build an exchange that's operating 24/7, 365, never turns off. Something can go wrong at any minute. So I think one of the most important things is, who is the team that is working on this, and are they here for the long game, right? Or are they here for short-term goals? And for us, we're here to build for the long term, and that's kind of born in every decision we've made. It's born from like our choice of tech stack, right? The reason we chose the ZK stack is it actually hurt us in the short run. So in 2024, when other dexes were basically scaling up to hundreds of markets, Paradex was stuck at about 10 to 15 markets for most of 2024. And that was basically due to our choice of the ZK stack and issues with data availability cost on Ethereum. And that prevented us scaling. Basically, at one point, transactions were so expensive that it was costing us more to basically settle a trade on Ethereum than we were earning in revenue. And then post, the Ethereum roadmap changing and updating to include blob space, basically those costs went away, but that prevented us from basically scaling up to 100 plus markets in 2024, which made it very difficult for us to compete at that time. But we made that choice because long-term, we think ZK scales infinitely better than the solutions of some of the other competitors. Basically, a singular L1 architecture where you have full execution on chain. And this is because like in a world where, I guess one way to think about it is like everyone talks about TPS, right? It's the most commonly quoted metric. We at Paradex think that's like a terrible, it's like almost like a meme, right? TPS can mean anything, right? Typically TPS is measured as like a basic swap of like a native asset on the chain. But like when Paradex is at scale, we're going to basically have spot, options, perps, all traded from a single unified portfolio margin account. And you can also fund it with any type of collateral, so multi-collateral. the complexity of that system in terms of like risk checks that you need to do, right? If I deposit Bitcoin, I basically need to constantly be pricing in a US dollar value to figure out what margin you can use. Then let's say you're trading options, spot, you need all of them to be shocked in different risk scenarios so we can figure out your initial margin requirements. But like that is orders of magnitude, and it's not linear, it's exponential, more complex than a single swap.
Right.
And so for us, like we've chosen the tech stack we have to scale to that end game. And so I think while some folks have like basically been like, hey, let's get to market as soon as we can, and we'll basically get a dominant market share in the short term. You know, our approach, having, you know, being a bit of a later entrance into the market, was like, hey, we need to make sure like the end game, we have the right level of scalability for our platform. And so that's been a huge reason why we chose the tech we did. And while short term, it may have hurt our ability to scale, long term, it's set ourselves up to really start to differentiate our product. Because I constantly hear the whole space, even the name perpstex, like Paradex is not a perpstex. We are like fundamentally not a perpstex. It's never been that part of the vision. It's always been about building a holistic exchange on chain, which includes, again, spot, perps, options, all from portfolio margin account.
Yeah. I think that the market has come around on later participants. So previously we thought, or maybe the consensus opinion was that first to market was the best. And there were a lot of first to market winners. And now we're seeing that, you know, more sophisticated teams that wait for better, you know, technical architectures and make stronger product decisions are the winning teams. And it just took a while for that thesis to play out because the first players to market did have an advantage. Speaking of first player, or the first to market players in the decentralized exchange space, there's a lot of names from, let's call it 2020, 2021, 2022 that we do not hear anymore. Why did those perp dexes fail?
I think it comes down again to like the thing that's going to matter the longest, you know, in terms of who are the ultimate winners here, is basically like, I think if you look at the like where we are in this race to building these exchanges, we're still in like inning 1 to 2, I would say. And you know, for everybody to declare that there are any winners right now, to me, is insane, because the quality of product we've built, when you take like a 10,000 foot view, is like still not even remotely close to where it can be or where it will be in another, you know, 3 to 5 years.
Right.
And so what really matters is like which teams are constantly iterating and improving the product. Because like, again, the game for me is not how do we capture the current pie of decentralized traders, right? The game for me is like, how do we get customers from centralized exchanges? How do we get customers from traditional markets? And how do we bring everybody on chain? And so like, if you look at the experience of any of these platforms right now compared to, you know, platforms that exist today in TradFi or the centralized exchanges, like the gap between where we are now and where we need to go is so enormous that like, what really is going to matter is which teams are constantly iterating, making the product 1% better every day, you know, compounded over 3 to 5 years. And so I think that some of the projects that came out of the gate early, they basically like were maybe the only game in town at the time. But they failed to kind of like continue to just iterate, improve the product. And then really I think the other thing is like, are you speaking to your users? Right. And like, are you building something that they want? And how attentive to their needs are you? And that's where like, you know, if you look at the Paradex Discord, for example, like everybody on the team is in the Discord constantly getting feedback from users, constantly iterating on that feedback to make the product, you know, better for our users. And yeah, I think like you just can't get complacent in this game because this is the most competitive space I've ever worked in. That's shown by the explosion of competitors that have kind of come out. And so like, how do you differentiate yourself in this open source world where basically any idea with time and resources, somebody can recreate it? It's basically like how fast your team can continue to iterate, ship, and how you can basically skate to where the puck is going and not to where, like everything needs to be building towards a vision that maybe other founders or other teams don't see. And so if they're constantly copying you, but they don't really know where you're going, that gives you basically an edge over the long term. And then as exchange, the hardest part is like, how do you bootstrap liquidity? That is the hardest problem in this space. Anyone can build the tech, anyone can build an exchange, but can you get people to trade there, and can you get liquidity into that exchange? And that's a two-sided marketplace bootstrapping problem that has been very, very difficult to do historically, and I think it's a reason why you'll basically see the winners are going to consolidate around a handful of players that are able to effectively bootstrap liquidity and basically create the perps DEX as this like central cluster of economic activity on chain. And we think that there's basically going to be a handful of super clusters built around perps DEXs around which giant ecosystems and economies are basically going to be built.
I want to go back a little and then talk about this liquidity problem. You have a bit more perspective as someone who was in the TradFi world and came to crypto. What does it take to get, a TradFi trader on chain? And are we even close to that?
Yeah, it's a good question. I mean, it comes to the institutional side, and I think there's still a lot of work to be done to be getting, true institutional firms on chain. So I think that's still like a multi-year effort. There's a lot of regulations that they're susceptible to, right? So I think, what we've seen in crypto to date is basically the smaller institutions and guys that have been super flexible to basically structure businesses and able to trade crypto have been the first movers in the space and have been, very, very successful.
Right.
But the larger institutional firms, they are very slow moving businesses. And it's really going to take a robust regulatory framework that allows them to operate in there. And we've clearly seen a lot of positive movement coming out of the US, which I think the world will kind of follow. So it's going to take, for those really archaic industries to move on chain. I think it's inevitable, but it's going to take more time for the regulatory framework to really clear up to allow those guys on chain. But I think in the interim, they can play it by basically spinning off more nimble organizations that are basically structured to go play in this kind of new environment.
Right.
But it's going to take things like privacy, high throughput, deep liquidity for them even to get interested, right? Because if they look at a marketplace and they say, hey, I can get 5% or 10% market share of this exchange, the exchange is trading 100 million a day, they can't make the math work for them to even think about it. But if that's at a venue is now trading $100 billion a day, all of a sudden that's a massive economic opportunity for these firms to come in. And then that will force them to basically spend the resources to figure out, how do I structure myself to basically enter the space?
Okay, so a way to think about it would be like, it's not even worth it for an industry or for some of these industries to participate until they can kind of like have a market size that's justifiable to kind of like siphon off a little bit of this value. And that's kind of how those industries work. And
yeah,
in a lot of cases, it just wasn't big enough until now. That kind of ties into this liquidity problem. So liquidity supercluster, that's an interesting word or pair of words, I guess. Talk to me about, well, first of all, what you guys are doing to bootstrap liquidity. Yeah. And second of all, your thesis around liquidity generally and how Paradex can become this kind of like, gravitational center for liquidity in the space.
Yeah. So it's a really interesting thing. I mean, we've seen a lot of the cool thing that's been happening in the DEX world is there's been a lot of innovation in terms of like what people are doing to bootstrap liquidity. And it's a hard problem because it's a chicken or the egg problem, right? If you're a market maker and you're coming to a new venue, you're basically looking to say, okay, I have a fixed cost of integrating into this venue. And then on top of that fixed cost, I have opportunity cost of trading on some other venue and my time and attention of a trader to basically pay attention to this venue. And right. And again, that kind of goes back to that framework of like, I look at the venue, how much volume is it trading? What % market share do I think I can capture? What is my average P&L on that market share? And I can basically come up with like what is the economic value to integrating with venue X, Y, or Z? But the problem is like you have that on the liquidity side. And then on the other side, you have a retail trader who's like coming to the platform or an institutional trader that's not like a pure market maker. And so like who goes first, right? How do you get the users if you don't have the liquidity? And how do you get the liquidity if you don't have the users for them to have a clear economic incentive? And so that comes where you have to basically figure out the right level incentives, and it's a very difficult problem that we all face. And so the other challenge is when market makers come to the market is, are they going to get run over by other high frequency trading shops, right? And this is where, Paradex has made some, I think, fundamental micro market structure innovations that have helped us bootstrap liquidity on our exchange. And so we looked at the market and we said, okay, if you're in a central limit order book and you're a market maker, basically you're constantly putting prices into the order book, but you have the risk that basically somebody out there is faster than you. They may have a better idea of where price is going because they're connected into more venues, they have more data. And so if you're slow at all to adjust your prices when the market moves, some high frequency guy can come in and pick you off, and basically you immediately lose on your position, against that trader. And so as we were kind of bootstrapping our initial marketplace, we could get some market makers on, but for them to show more size and tighter prices, it was very difficult because there was always this kind of risk of like, well, if I size up and I tighten up my prices, I'm getting picked off by somebody faster and smarter.
Okay, so market makers would come in and they would kind of have a really conservative approach, which meant that liquidity wasn't effective, liquidity wasn't deep.
Yeah. And then the retail users come and they look at the order book and they say, hey, this isn't a deep order book. And so that was like the fundamental problem we were struggling with really until like the mid 25. And you basically have to figure out, okay, like how do I get enough good retail flow to come in to make it juicy for market makers, to basically offset the negative effects of like the higher frequency toxic guys.
Right.
And so for us, that was like, it was quite a challenging, chicken or the egg problem to solve, until we kind of realized that like, hey, what if we take a fundamentally different approach to this? Which is, what if we basically segment users and segment flow? And so this led us to this idea of what we call RPI, retail price improvement. And basically RPI is a special order type that a market maker can put in the market. So when they're putting quotes in, they basically tag it with, is RPI equals true? And these orders have special properties. So they can only interact with a type of user profile that we have. Basically, we call it crudely a retail profile, which is basically like a code word for a non-toxic, non-high frequency trader. And that basically says, so like retail traders basically have activity limits, so they can't trade more than 10 times per second or 1,000 times, per 24 hours. So it's basically for users that are not engaging in high algorithmic churn, that are trying to, make money on very short time intervals. These are your average traders like you and me. Like, I think the price of Bitcoin is going up tomorrow or 1 week from now, so I want to buy, and I'm not trying to make money over the next 5 milliseconds or 10 milliseconds. And so from a market maker's perspective, that's who you want to trade against, right? A market maker's core job is to basically intermediate between buyers and sellers, but they don't want to hold inventory risk, right? So they just want to match. You want to sell today, I want to buy tomorrow, and we maybe have different amounts of price or size of trades that we want. They just sit in the middle and kind of facilitate those flows.
Right.
So what we've done now is with RPI is we've created a segmented, curated group of users for market makers to trade against that are not toxic to them on very short intervals. So it's really good flow for them to trade against. And that gives them comfort to basically show more size in the order book and to show tighter prices. So we have that lane. And then we also have a regular lane, which is where all the HFT guys can play. And that's basically how we've kind of solved this problem, is us deciding to segment users into different buckets, which will then allow improved prices to people that are non-toxic to the liquidity providers.
And how does that interact with the retail user? If this benefits the market maker, is this to the retail user's detriment at all?
No, not really, because it's actually to their benefit. And we actually track all these metrics. So we track basically, if you're a user executing a trade on Paradex, what you're most concerned about is, one, how much fees do you pay? 2, what is the spread that you pay, and then 3 is like the slippage, which is basically like this risk of makers canceling before you actually get to execute against them. And again, given that like the market maker basically at scale is just trying to trade against people that don't have a very, very short-term edge. And they obviously need to get compensated in terms of like the spread that they show on an instrument, because that's how they make money.
Right.
But the difference is if I'm trading against 2 users, one who's going to pick me off very short term and one who I know has no view on the market where it's going over the short period of time, the risk associated with those 2 traders is much lower for trading against the retail profile user, because I know that like it's basically a 50-50 coin flip whether the market's going to go up or down right after I trade with him.
Right.
And so if you think about like what a market maker is doing, they're trying to trade at scale. And so if at scale it's a 50-50 coin flip versus I'm trading against the HFTs and I'm going to lose, 60% of the time I'm actually losing money on a short period of time, my risk is lower. Therefore, I can basically trade more and I have maybe smaller margins, but I can trade more at scale. So basically that like all that is passed along to the retail user in terms of tighter spreads.
Right. The other thing you mentioned, fees. What do retail users pay on fees, and how is this possible?
So basically, one of the things that RPI led us to was this will allow us to potentially offer a zero fee model for retail users. And when we first launched RPI, we were still running a very simple 3 BIP taker, and we were actually rebate our 2.5 BIP taker and half BIP rebate on the maker side. And that was actually, it was harder for us to articulate the RPI benefits there because basically like we were incentivizing market makers, plus they had the safe lane. So they're actually pricing things and they were quoting in cross books. So basically what does that mean? That means that as a retail user, you're actually, as soon as you trade, you were actually in the money versus the mark position of the instrument.
Right.
But that was a little bit harder message for us to tell retail users, like, oh man, your execution quality is so good, you're actually start the trade slightly positive versus slightly negative. But we realized what this could do is basically allow us to offer free trading for this kind of non-toxic group of users. And that allows us to basically simplify the message. And it also allows us to kind of disrupt the industry at a core level. Because one of the other things that we saw is like on the centralized exchanges in particular, is they charge, for simple retail users upwards of 4 to 6 basis points. And then a lot of these users are coming in through affiliate deals. And those affiliate deals are paying 50 to 70% of the fees back to the exchange or back to the KOL or affiliate that introduced them.
Right.
And so we're looking at this and we're saying retail is paying these large fees, but a lot of that is actually not even going to the exchange. And so the real economics that we're trying to disrupt are actually, much smaller. And if we build a direct to consumer model, we can basically offer them very, very low fees and still have the same or similar net economics as these other venues. But basically we have a much better value prop because fees are a huge part of the execution cost for traders.
The other part of the current value prop, I guess, for users right now is you guys also have kind of like a points XP system. Can you talk about that a little bit and how that might benefit a retail user?
Yeah. So basically, obviously one of the powerful parts about crypto is like, how do you incentivize and bootstrap your community? And the point system we have now is called XP. And basically what we're really trying to do is we're trying to reward users that are helping add value to the protocol. And so XP is intentionally an opaque metric where we don't tell people exactly how it works.
Right.
But what we do is basically broadly say, what are the types of activities that you can do on Paradex that will earn you XP. And that's pretty clear. It's basically like, what is value at an exchange is not that difficult to understand, which is the nice part about an exchange, which is, things like how much volume are you trading, how much open interest, so open positions do you hold, how much capital have you committed to the exchange? Basically, like what are measures of like a healthy user of an exchange, and we basically incentivize that with our XP system.
Excellent. What's the ultimate kind of scope or ambition of a product like Paradex?
Yeah, I mean, I think I mentioned it earlier, but this kind of goes back to like, as much as we have to just, kind of accept the narrative of a perp stacks, that's such a small part of basically our larger vision.
Mm-hmm.
Which has always been, much bigger. And I think let's just take the exchange side. So I think for us, step one is to this, Paradex network story is basically getting the exchange up, bootstrapping it to deep liquidity. And so that for us is, again, it's perpetual futures, it's options. So we already today have live perpetual options, which we could probably do a whole different podcast on that. So I won't spend too much time on it. But basically expireless options. We're going to be launching dated options and leveraging the Paradigm network to bring a lot of trading on chain. And then spot, again, from a single account. So basically creating the best in class trading experience for traders on chain.
Mm-hmm.
But then the other angle to Paradex is that, the Paradex chain itself, again, we've talked about this as an application specific blockchain, as that's the ZK-L2 today. And we've already opened that up on testnet, but we'll be opening that up for development, so people can build on top of our chain and really build on top of the core liquidity primitive of the exchange. And for us, that represents the much longer term model, which is like everybody needs the core engine of liquidity on the exchange. So we'll bootstrap that first, and then second is when we basically start to focus on the chain. And how do we encourage builders to come and basically build, all sorts of apps on top of this core liquidity engine? And we'll do that basically in a model that will look similar to kind of a Roblox model, where we're kind of like, apps can come to us, they can create additive services, they charge their end users, and then they pay, let's say a 30% share back to the protocol, which will then get returned to token holders as value accrual. So I think there's a lot of really cool stuff that will come out of that once we get this core liquidity engine and exchange engine up, because the things you can build on that are just insanely large in scope.
Right. It's almost we too see kind of centralized exchanges working on this model where they launch an L2 and they're kind of trying to have these network effects kind of bridge between the centralized exchange and the L2, or they have a chain or something. But really, it's much more elegant actually if the exchange is already decentralized and I already have assets on chain and they can be collateralized in different ways, or I can offer yield, or apps can offer yield to attract the the value going somewhere else, or all this composability. So it's really a kind of new unlock in the exchange space in a lot of ways.
Yeah, I think one of the primitives that we haven't talked that much about yet is we have a vault primitive on Paradex.
Right.
And basically what this is to us, this is like asset management on chain.
Mm-hmm.
And so, when we think about like all the various things, like what the Paradex network is gonna create, it's basically like if you take all of the financial services that exist today, you can put a wrap around all that, and basically the Paradex network will represent all that. And so one huge part of the financial system today is asset management.
Right.
And so vaults basically for us are this primitive of like a wrapper. It's a special account that basically can delegate another account to trade on its behalf. So you can think about this like an asset manager. And then all depositors basically deposit money into the vault. They get a tokenized representation of their share of the assets in that exchange. So let's say there's $1,000 in the vault and I've put in 500 of it. I have tokens that represent 50% share of this vault. And then somebody can basically be the vault manager, and they can then run a strategy. And that strategy can basically be based on any of the core primitives of the exchange. So it could be a future strategy, it could be an option strategy, it could be a spot strategy, it could be any combination of those three. So basically you can now see the design space for what you can do out of this vault is infinite, basically, because it represents, in the old TradFi model, it'd be basically like, this is prime brokerage plus fund admin plus like all these things that just like, hey, I want to start a fund and I want to manage it. All this wraps directly into the vault primitive. And so long term, we think this could really enable like insane innovation on the asset management side, where whether it's institutions or smaller hedge funds and things can basically spin up their fund on Paradex itself. And then they can either choose to have closed distribution to a list of investors they whitelist. They can choose to open it up to anybody. And then basically they can then say, hey, I want to take a 20% performance fee for running this vault. And then part of that would basically be sliced off to go back to the protocol as well. But just like the size of asset management in traditional finance is just absolutely enormous. And we think that will come on chain. And vaults is like this early primitive that we're developing that will basically serve that entirety of that market.
Right. You have been in this industry for a lot longer than most people that are in this industry. What keeps you coming back every day working on these problems?
Yeah, I think, it's crazy because I guess, I first started in late 17, 18. I did take a break for a couple of years in the middle, but then decided to hop back. And I think just the pace of innovation in crypto is like nothing I've ever experienced. And it's really fun to basically have, we built an entire exchange on chain in like less than 2 years.
Yeah.
Right. And now there's still a ton of work to be done, but it's insane to think about, like, when I was working in TradFi, the idea of like building an exchange. I mean, it sounded insane.
Yeah.
But we were able to do it in 2 years. And it's just, there's nothing that even comes close to the speed of innovation and my ability to work with some of the smartest people in the industry that are pushing, every part of the tech. On the blockchain side, we're pushing the issues on like, how do we scale this thing 1,000x from here? On the market structure design, like all these innovations on the, with RPI and micro market structure innovations, and just like the ability to just say, hey, we want to do this and do it. There's no other space that even comes close to this. So it's like a drug. You can't like, once you get a flavor for like how quickly this is and how cool, the things you can build are, it's really tough to go back to like I can't even imagine. Every once in a while I'll get an email from a recruiter like, hey, do you want to come back to TradFi? And it's just, I couldn't even imagine my life, outside of crypto now.
Right. Well, that's a great spot to wrap up on. Thank you so much for your time. I've had a really enjoyable conversation with you, and I know we could go on for another hour. So, thanks so much for being here. We appreciate it.
Yeah, appreciate it. Thank
Excellent.
you.